Welcome to the Vold Revolution channel.
And welcome to the deep dive. Today we are undertaking a mission to distill the wisdom from one of finance's most compelling, and I mean really most lucrative intellectual gambits, the Richard Dennis experiment, famously known as the turtles.
Okay, so let's unpack this right away. The central story is it's almost mythic.
It really is.
In the early 1980s, you have this guy, Richard Dennis, who's a legendary, completely self-made commodities trader. And he decides he wants to prove a point.
A very, very big point.
He claimed he could take literally anyone, complete novices, people with zero connection to finance, no experience at all, train them for just 2 weeks using his private rule set, and turn them into million-dollar traders.
And our sources confirm he actually did it. 23 individuals were picked for what was, essentially a remarkable social experiment.
What makes this story so foundational, I think, is just the sheer arrogance of it. And I mean that in the best possible way.
Right. It was this huge challenge to the established Wall Street orthodoxy. For generations, the main view, the one echoed by titans like Benjamin Graham, was that the financial elite, the people with the best information, the strongest pedigree, they would always get the profits.
And the academics back this up.
Oh, completely. With the efficient market hypothesis. The idea that information just travels so fast that no individual, and certainly no quote-unquote little guy, could consistently beat the market.
So the message from the establishment was really loud and clear.
Yep.
You need Ivy League degrees, you need exclusive connections, and you need to be in those gleaming steel and glass towers in Manhattan or London.
And Dennis, he basically looked at all that and said, that's nonsense. He believed the only thing you needed was a precise set of rules and, critically, the emotional discipline to actually follow them.
And the proof? Well, the proof arrived in the most unexpected way. It really highlights just how far from the establishment the real money could be made.
Yeah, that part of the story is fantastic.
Absolutely. The origin for one of our main sources really emphasizes this surprise. The author talks about picking up a Financial World magazine back in 1994.
Right, the issue listing Wall Street's top players for the year before, the who's who of high finance, the guaranteed winners.
And that list was just staggering.
Astronomical. George Soros was at the top with a $1.1 billion haul.
$1.1 billion.
And then you had Julian Robertson in second place at $500 million. These were the names everyone expected to see. No surprises there.
But then you get down to 25th place, and there's the shocker. A name. R. Jerry Parker Jr., listed with $35 million in annual earnings.
And the description next to his name was brief, but it was revolutionary. It said he was a former pupil of Richard Dennis, trained to be a turtle.
And here's the detail that just proves Dennis's whole point. This is the kicker. Parker wasn't in a Chicago pit or some Manhattan penthouse.
Not even close.
He was operating 30 miles outside of Richmond, Virginia, running his fund from a country office in a place called Mannequin-Sabot.
That one geographic detail is such a profound statement.
It is.
It just completely dispelled the idea that you had to be near the market hub, the physical heart of the establishment, to succeed. Millions were being made consistently, miles and miles away from the traditional gates of finance.
It proved the system, the knowledge itself, was portable.
Exactly.
And that raises the central question that's going to drive this whole deep dive. How did these people, these disparate, often uncredentialed people, even get selected? And what were the specific proprietary rules they followed?
We are going to unpack the intellectual rivalry that started all this, the rules themselves, and ultimately whether this was the definitive proof that trading success is rooted in nurture, not nature. Tag one nurture versus nature.
Let's start right at the beginning of the experiment, which it wasn't some calculated business move. It was really the end result of a decade-long intellectual wager.
Nurture versus nature.
Exactly.
And this was a true battle of wits, a philosophical clash between two incredibly smart men. On one side, you had Richard Dennis,
the intuitive, almost anti-establishment trading savant.
And on the other side, his partner, William Eckhardt, who was a rigorous mathematician and really a philosophical determinist.
So Dennis, who had already made hundreds of millions with his own unique market instincts, he argued passionately that trading ability was entirely teachable.
That it was a skill, just a process, like learning to fly a plane or play chess. He believed you could exploit the market's irrationality if you just had the right instructions.
But Eckhardt was the skeptic here.
A huge skeptic. He looked at Dennis's almost supernatural ability to spot these massive trends and just ride them, and he concluded that Dennis had something special.
Something innate.
Yeah, almost genetic talents that you just couldn't transfer through an instruction manual. Eckhart was convinced Dennis was an anomaly, this introverted genius.
So that famous turtle nickname, which Dennis apparently picked up after visiting a turtle breeding farm in Singapore,
Right.
it perfectly encapsulated this whole nurture idea. He saw the controlled environment, the mass production of these animals, and he just declared, we are going to grow traders just like they grow turtles.
The implication being, if you provide the right environment and the right rules, success will bloom no matter what the original seed was.
So to settle this bet, they had to design a test, one that completely bypassed all the usual filters of high finance, the Ivy League degrees, the corporate resumes. They needed to prove that people without that pedigree could succeed.
And how did they do it? The method they used was, it's almost laughable for how simple it was considering the stakes.
A classified ad.
Classified ad. They budgeted $15,000 to place ads in late 83 and 84 in these huge publications.
The Wall Street Journal, Barron's, the International Herald Tribune.
And the wording of that ad was it was revolutionary. It was looking for commodity futures trader trainees, and it explicitly said prior experience was optional.
That's the key.
And they promised training in Dennis's proprietary concepts. And critically, they would pay the new traders a percentage of the profits using Dennis's own money.
Which was just unheard of. I
Yeah.
mean, proprietary systems were guarded like state secrets back then.
And Dennis was just offering the keys to his kingdom to complete strangers.
So what kind of response do you get from an offer like that?
Mass hysteria. Applications just poured in, and it really showed how confused the general public was about how wealth is actually made.
Our sources talk about everything from like a single desperate sentence scrolled on a coconut shell,
A coconut.
all the way to these extremely mundane, formal resumes.
But Dennis and Eckhart, they were looking for a specific profile, even if it wasn't the standard Wall Street one. They wanted high math aptitude, high ACT scores, an interest in computers, a systematic way of thinking.
But beyond the academics, they were looking for something else. A willingness to take calculated risks. People who had odd ideas.
Right. A lot of the people they ended up hiring were chess players or backgammon players, people who were just used to calculating odds and thinking several moves ahead.
The screening process then had this crucial test phase.
Yeah.
Candidates got a formal letter which promised a very nice 15% of profits after training.
And with it, a dense 63-question true-false test. But this was designed less to test what they knew about markets and more to test their mental flexibility.
Their ability to throw out flawed conventional wisdom.
Exactly. The questions were deliberately counterintuitive. They targeted the emotional flaws that are so common with amateur traders.
Like the statement, a trader should be willing to let profits turn into losses.
The correct answer for the turtle system was true. Because if you're a trend follower, you have to accept those temporary pullbacks to catch the really massive moves.
And conversely, the idea that it's good to average down when buying.
Unequivocally false. Which is a direct contradiction of that common fatal flaw of traders who just hope a bad trade will turn around.
The last step was the interview, and that was all about gauging risk tolerance. And there's that famous anecdote about risk appetite that just perfectly shows Dennis's non-judgmental approach.
Oh yeah, the question about the $100,000 account. They asked what percentage they would risk on a single trade.
And the answers they got were astonishingly far apart, yet both people were accepted.
You had Curtis Faith, the youngest candidate, who said 99%. An answer that just screams calculated, almost suicidal aggression.
And then you had Liz Cheval, one of the few women selected, who said 1%, which represents extreme conservatism.
And Dennis hired both of them. He figured that between those two extremes, he had the whole spectrum of temperament covered. He wasn't looking for conformity.
He was looking for people who understood their own risk profile.
Yeah.
And you can't forget Jeff Gordon, the attorney, whose main appeal was writing that he spent more time playing chess than he did attending law school.
That commitment to systematic thinking over a legal pedigree got him the job.
So the resulting student body was just remarkable. It completely shattered the myth that trading required a certain background.
It was so diverse. They did hire academics like a Harvard MBA, Michael Cavallo. But the group also had Liz Cheval, blue-collar types, a former security guard named Jim Melnick,
And Mike Shannon, a former actor who actually admitted he falsified his resume.
and maybe the most telling hires were the really systematic thinkers from other fields like Jerry Svoboda and Tom Shanks. They were master blackjack players, card counters.
So they already had that mathematical rigor and the emotional detachment you need to just follow an edge relentlessly, even when the cards or the market seem to be against you.
They understood probability implicitly.
Once they were accepted, these people all signed a contract. A 5-year confidentiality agreement. The rules are top secret.
But the key thing for the novices was that they were not liable for any losses they generated while trading Dennis's money.
The risk was all on Dennis.
All of it. In return, they couldn't trade for themselves or anyone else during the contract.
An incredible deal. A free education in a secret system, using someone else's money, with literally no downside risk.
It's no surprise that not a single one of the accepted candidates turned it down. They had nothing to lose and millions to gain. Hashtag #2 Prince of the Pit.
To really appreciate the scale of the risk Dennis was taking here, we have to spend some time on the man himself. Let's look at the phenomenon of Richard Dennis, Prince of the Pit.
Dennis was, he was truly unique. His earnings trajectory was just staggering. He was a millionaire by his mid-20s back in the early 1970s.
And by the early 80s, when he was dreaming up this turtle experiment, his fortune was estimated around $200 million.
He had an $80 million year in 1986 alone. I mean, the numbers are just hard to comprehend.
And he was a character who just defied all categorization. He was this hugely successful, incredibly wealthy money manager, but he also acted as an anti-establishment political activist.
Right, spending millions to finance liberal and libertarian causes. He was using the establishment to make a fortune while openly rebelling against it.
And often wearing jeans in the trading pit while doing it.
Crucially, he detested being called a gambler. He rejected that whole idea of betting on hunches.
He saw himself as a master of probability. He operated under what he called financial Darwinism.
The market wasn't a casino where luck was king. It was a system that you could statistically beat by consistently taking these high-probability edges.
And his origins were decidedly blue-collar. He started at the Chicago Mercantile Exchange, the CME, as a runner when he was 17.
Making $1.60 an hour.
And since the rules said he couldn't trade until he was 21, he had to use his own father as a proxy, signaling trades with these complicated hand movements from the sidelines.
And his academic background, it profoundly shaped his trading philosophy. He actually flunked accounting.
Down the rules too limiting.
Exactly. Instead, he studied philosophy at DePaul, and he focused heavily on the British empiricists, David Hume and John Locke.
This philosophical immersion is so critical to understanding the turtle system. Locke argued for tabula rasa, the idea that the mind is a blank slate, no innate ideas.
Knowledge comes only from experience.
And Hume reinforced this skepticism, urging people to reject internal, emotional, or traditional biases in favor of external, observable evidence.
So Dennis became a pure empiricist in his trading. He learned to reject any kind of conventional wisdom, realizing that the market was often irrational. His skepticism grew from watching things like the 1968 Chicago riots near the Board of Trade.
That led him to conclude that the vast majority is wrong even more of the time. The market was just a reflection of mad crowds.
And that philosophical skepticism translated directly into his methodology. He rejected the standard attitude about money from his working class background.
Like his father equating a $50 loss to 8 hours of shoveling coal.
Right. That emotional attachment, Dennis realized, was just counterproductive for systematic trading. If you attach emotional value to money, you can't take small losses consistently, and you can't risk huge sums on winning streaks.
To Dennis, money was just a way to keep score.
He could have been trading with pebbles. The detachment was what was necessary for objectivity.
His non-traditional habits reinforced this. He wasn't reading crop reports, he was reading Psychology Today to stay focused on his own emotional control.
He would stay in bed until the last possible minute before the market opened, just avoiding all the noise that consumed other traders. And of course, the genes in the pit.
He built his first fortune by leveraging seasonal spreads, especially in soybeans. He started small at the Mid-American Commodity Exchange, the Mid-Am, treating his whole operation like a casino operator.
Just balancing risk with high volume and focusing entirely on taking edges, that statistical advantage you get from temporary market irrationality.
But the real turning point came when he realized the limitations of the physical trading floor, the pit.
He knew that to access global opportunities in fixed income, currencies, stocks, he had to get off the floor.
And that transition was agonizing. He struggled financially in the late 70s while he was adapting to the screen-based world, but he knew it was the future.
He famously told his friend, Tom Willis, that he had developed systems so good they could make $50 million a year.
A statement that sounded absolutely ludicrous in 1979.
But he did it. The move off the floor proved that his method could go beyond the physical pit and be applied universally across all different markets.
And it was that universal system, tested in the pit and proven in the global electronic market, that he wanted to mass produce with the turtles. #3 the turtles. All right, let's step into the environment where this whole groundbreaking educational process actually happened. The initial training for the turtles was set up with this delicious irony.
It really was. The 2-week intensive training was held at the Union League Club in downtown Chicago.
Which was the total antithesis of everything Dennis stood for.
Oh, completely. An old world, rigid institution. You needed a jacket and tie. They'd turn people in casual clothes away at the door.
And Dennis, the anti-establishment icon in his jeans, chose this place just because it was practically convenient to his office.
After the training, the actual working environment at C&D Commodities was just as functional, just as anti-flare. It was described as Spartan.
Metal desks, basic chairs, no frills, no coffee machine, no TV.
Though eventually they did get a ping pong table.
And the lack of a dress code cutoffs and T-shirts were normal? That was a constant reminder of Dennis's personality.
The training itself, led by Dennis, Eckhardt, and Dale Dellutri, who one source called the Team Mom, was super high pressure, but the most unconventional part was where the curriculum started.
Right. Instead of the typical, here's how to pick a winner.
Eckhardt immediately launched into managing risk.
This is such a fundamental lesson, and it goes completely against the grain of human desire for wealth.
Yeah.
Most people get into trading dreaming of the big score.
And the turtles were taught the absolute foundation, what to do when you lose money. They learned that in a zero-sum game, protecting your capital is the prerequisite for ever having a chance to win.
The teaching dynamic between Dennis and Eckhardt was a masterclass in collaboration.
Dennis would lead with these intuitive, lightning-fast observations. He'd point to a market move and say, look what this means. Look at the deep axiom in here, it works. He'd explain why something had to be true just based on his lifetime of observation.
And then Eckhardt, the mathematician, would step in to provide the intellectual rigor.
He'd synthesize the data, master the probability, and develop the computational model that would actually prove Dennis's intuition was correct.
Mike Shannon, one of the turtles, even said that a lot of the system's development, the really detailed math, was Eckhardt's intellectual heavy lifting.
And after the students were out there trading and making massive amounts of money, that central question that started the whole thing, nature versus nurture, it was definitively answered.
Eckhardt conceded.
He did. He admitted he was wrong about the genetic necessity of trading ability. He observed that, by and large, the turtles learned to trade exceedingly well. The answer to the question of whether trading can be taught has to be an unqualified yes.
He'd just dismissed the possibility of luck, given how consistently the group succeeded over multiple years and in all kinds of market conditions.
The statistical improbability of it all being luck just solidified the success of the methodology.
But maybe the most lasting observation Eckhardt made was about the role of intellect. He said that raw intelligence was secondary.
He noted, many outstandingly intelligent people are horrible traders. Average intelligence is enough. Beyond that, emotional makeup is more important.
So the real prerequisite wasn't a high IQ. It was the discipline, the patience, and the emotional fortitude to execute the rules flawlessly, especially during those painful drawdowns. #tech for the philosophy. Okay, so if the secret wasn't IQ, it had to be in the methodology. Let's dive into the philosophy that governed every single turtle trade, which starts with one single mandate. You have to treat trading as a science.
Absolutely. Dennis and Eckhardt required the turtles to think of themselves as scientists first, traders second. The entire approach was rooted in the scientific method.
You investigate market phenomena, you gather empirical evidence, the numbers, and you adhere strictly to the laws of reasoning, which were the rules.
And this philosophical discipline is what really separates them from the sizzle, the talking heads on TV, the get-rich-quick gurus. It's about theory and verifiable evidence applied pragmatically.
This pragmatic approach led to Dennis's most enduring realization that success came from using precise, objective rules, while failure was almost always rooted in subjective judgments.
When a system failed, it was because emotion, fear, or greed's subjective judgment had crept in.
And the rule set they were taught defined them as unwavering trend-following traders. The whole game was to wait for a market to start moving, then jump on board and capture the majority of that trend, whether it was up or down.
And you cannot overstate how difficult this is. Dennis himself said that pit traders often struggle with this kind of systematic trading.
Because they're reacting to the price tick right in their face.
Exactly. It leads to moment-to-moment discretionary and ultimately very poor judgments. The systematic approach forces you to detach from that immediate emotional reality.
And that detachment is tied to another core axiom. You trade the numbers, not the physical commodity. They weren't trading corn or gold or S&Ps.
They were trading mob psychology, which just shows up as price movement.
The key axiom here is so profound. Price is the reality and intelligence is the appearance.
Meaning the price reflects everything known about the market, all the news, all the expectations, all the fundamental changes, faster than any human analyst could possibly digest it.
And there are some great anecdotes that really underscore why news analysis is useless. One source tells this story about a commodities news reporter who admitted to a veteran trader.
I made it up.
When he was asked how he knew what sugar was going to do that day, it just emphasizes that relying on market commentary or news is often like chasing a ghost. By the time you act, the price has already moved.
So to operationalize this detachment, the turtles had to adopt what was called mental abstraction, memoryless trading.
They had to learn to treat money as abstract score pebbles, not something tied to their personal worth or security.
Eckhardt was especially strict about avoiding the psychological trap of looking backward, which he called the market vendetta.
The market vendetta, what is that exactly?
It's that psychological flaw where a trader who just lost money tries desperately to make it back in the exact same position or market.
So you lose $5,000 on a trade in Cisco, and you immediately double down because, well, now it's cheap.
That's revenge trading, and it's almost always catastrophic.
So the turtles were taught to be completely agnostic. You accept the small loss when the rule tells you to, and you immediately focus on the next trending opportunity no matter what market it's in.
They were specifically taught that the entry price of a trade should not matter at all to any subsequent decisions. If you bought corn at $3.50 and the system said sell at $3.20, you sold. Period.
You had to trade as if you didn't even know what your entry price was.
That way, sunk costs couldn't drive future emotional decisions. That level of discipline is just immensely difficult to achieve. #tag5 the rules.
This is where we get into the nuts and bolts, the actual proprietary material that Richard Dennis bet his reputation and his fortune on. And the turtle system wasn't a suggestion. It was a mandatory defined battle plan.
Correct. Eckhardt mandated that every potential trade had to start with answering the 5 questions of optimal trade before the market even opened.
And these questions guaranteed that emotion couldn't override preparation. So what were these 5 crucial planning steps?
First, what is the state of the market? Is it liquid? Are there trading limits? Things like that. Second, what is the volatility of the market?
The first 2 are just pure objective data.
Exactly. Third, what is the system or trading orientation? So are we looking for an S1 or an S2 entry or exit? Fourth, how much should be risked on this trade? That gets into unit sizing. And fifth, how is the capital protected? Which is all about stops and management.
Let's focus on that second question, volatility, because that brings in the most critical technical concept, N, or the average true range. I think this gets glossed over a lot, but it's the absolute key to standardizing risk across all these different markets.
It absolutely is. N is the heartbeat of the turtle system. It's a calculation of the average price fluctuation, the true range of a commodity over a certain period, usually 20 days.
And why is that so essential?
Because a 1-point move in a gold contract represents a totally different amount of money and therefore risk than a 1-point move in a corn contract. They're not the same at all.
So N lets them quantify risk objectively. If a corn futures contract has an N of 7 cents and gold has a much higher N, they can still adjust their trading size so that the dollar value of the volatility is equal.
Precisely. If one standard risk amount, say $350, is equal to 1 N of volatility for corn, they adjust the number of contracts they buy so that the total potential dollar risk per 1 N move is the same, whether they're trading highly volatile Japanese yen futures or stable bond futures, and standardized everything.
And this objective quantification let them calculate their edge formula, or their expectation, which proved mathematically that the system had a positive expectancy over time.
The formula for expectation is E, PW, XAW, PL, XAL. E is the overall edge. PW and PL are the percentage of winning and losing trades, and AEW and AL are the average size of those winners and losers.
And this formula just demonstrates why having a high accuracy, winning a lot, is utterly meaningless on its own.
Yeah, can I walk you through that example from the source material? It really drives the point home that being right less often can still make you rich.
Please do.
Okay, so imagine system A, which has 50% winners. Pretty high accuracy. If your average winner is $500 and your average loser is $350, your edge is calculated as 0.50500, 0.50350, which equals $75 per trade. That's a decent system.
Okay, makes sense.
Now consider System B, which only has 40% winners, so lower accuracy. But if your average winner is $1,000 and your average loser is still $350, the edge becomes 0.401000, 0.60350, which gives you an edge of $109 per trade.
Wow, that is a staggering difference.
It is. The takeaway is clear. The percentage of accuracy means absolutely nothing. What matters is the ratio of your average winner size to your average loser size.
The turtles were designed to be mass merchandisers. They had 90% loss leaders, and that 10% of gigantic outlier profits paid for everything.
So moving to the actual entry systems, they use two variations of a systematic breakout strategy. System 1, or S1, mandated a buy or a short sell if the market made a new 20-day high or low.
And System 2, S2, just used a wider window.
Right, a new 55-day high or low.
And the S1 system had that really critical filter rule to prevent getting whipsawed.
Yes. They were taught to ignore the S1, the 20-day breakout signal, if the last 20-day breakout signal had been a winner.
And why was that?
That rule was designed to avoid jumping in on these small, short trends that just quickly reverse. It filtered out choppy markets and made sure they were reserving their capital for the potential big, persistent moves that actually defined their edge.
But the real genius of this system was in the risk management and unit sizing. This was the safety net. The core rule was conservative. Risk only 2% of the total account value per trade.
And this is where N becomes so important. The unit size calculation was a bit complex, but it ensured that 1 unit of risk was always equal to 1% of the total equity, adjusted by volatility.
So can you give us a concrete example of that unit size calculation?
Sure. Let's say you have a $1 million account. 1% risk is $10,000. Now, say you want to trade crude oil. If one contract of crude oil moves by 1 N, and that move represents a dollar risk of $2,000, then your maximum unit size for crude would be 10,000 divided by 2,000. So you could trade 5 units or 5 contracts. But if you move to a less volatile contract where 1 N was only a risk of $500, you could trade 20 units to keep that total risk equalized at $10,000. It's the heart of capital preservation.
And they had a strict defense against the ultimate disaster, the risk of ruin.
If their total account equity dropped by 10%, a significant drawdown, their unit size was automatically reduced by 20%.
That's a critical rule.
It forced them to bet less aggressively during losing streaks. It protected what capital they had left and ensured they stayed in the game long enough for a profitable trend to finally show up. It prevented panic and catastrophic failure.
And finally, the profit driver, pyramiding. This is where they went from being conservative risk managers to aggressive opportunity capturers.
Pyramiding is adding to your winning positions the absolute opposite of what emotionally driven traders do, who tend to cut winners short and let losers run. The turtles were allowed to add up to 5 units to a winning position for every 1 N move that went in their favor.
That sounds incredibly aggressive. But the risk management built into it is the key to why it worked.
It is. As each new unit was added, all the stops on the entire position had to be moved up to the 2 N stop of the newest unit. This ensured that their open profits were systematically protected. They weren't just adding risk, they were financing new risk using the market's own money, their open profits.
That disciplined, systematic aggression on winning trades is exactly how they got those fantastic returns. They used the market's money to bet bigger when the market confirmed they were right. #tag 6 in the womb. So armed with this incredibly comprehensive, mathematically rigorous system, what was daily life actually like for the turtles in the womb at C&D Commodities?
It was, ironically, a rather boring strategy.
Boring.
Yeah. Trend following is fundamentally a game of patience and inaction. If there wasn't a strong trend, the rule was simple. No trending market, no profit. They could go for days or even weeks without placing a single high-conviction trade.
That really contrasts with what you expect a high-stakes, fast-money environment to look like. I mean, today's hyperactive crowd who are constantly checking their screens would find that kind of mandatory downtime unbearable.
And that ability to do nothing when the rules told them to do nothing was a prerequisite for success. Jerry Parker's behavior is a great example. He spent his downtime figuring out all the tricks to an electronic baseball game.
Which was a demonstration of methodical focus and self-discipline, not just goofing off.
Exactly. They were just waiting, prepared for this statistical edge to finally appear.
But despite the technical boredom. The group dynamics and stress must have been palpable because of the high volatility of their performance.
The sources reveal a really crucial psychological insight here. The turtles made the vast majority of their money in maybe a 2 or 3 week period during a normal year.
Wow.
The rest of the time, because of all those necessary small losses from false breakouts, most of them were probably down 30% of their equity.
Getting the crap kicked out of them, as one source put it, on a day-to-day basis with small losses. That must have been mentally exhausting.
Absolutely. And this is why the group provided such critical psychological support. When you're down 30% and you're facing constant losses, your human instinct is screaming at you to stop trading.
But the collective experience reassured them.
It did. It showed them the drawdowns were normal, that they were still following the rules, and that the statistical edge would eventually materialize in a massive trend. That shared misery validated their disciplined inaction.
But that environment also fostered some undercurrents of inequality and competition.
Well, the competition was natural because the performance was public. But the friction was really made worse by Dennis using control group members, his friends and employees, alongside the turtles hired from the ads.
So some of the ad-hired turtles who had survived that brutal screening process were questioning the mental horsepower of the control group hires.
Yeah, like Lucy Wyatt, a friend of Eckhardt's.
And there was also significant political friction, which just reinforces Dennis's complex anti-establishment persona.
Right, Dennis was a liberal libertarian, a supporter of Walter Mondale in 1984. Meanwhile, you had conservative evangelical Christians like Jerry Parker.
And Jeff Gordon, who supported Gary Hart and directly challenged Dennis's politics at dinner. Gordon was eventually cut, though the reasons given were trading-related.
But ultimately, as Liz Chevelle pointed out, the in-office rivalry was stark because the performance was purely objective.
The numbers are there in black and white. Either you made money or you didn't. #tag7 who got what to trade. And that objective measurement of success leads us right into the most contentious part of the whole experiment, the allocation controversy. The premise was equal opportunity, but the practice of handing out trading capital was anything but equal.
This created massive internal tension, especially among the second-year class. Curtis Faith, the youngest turtle, he received these disproportionately large allocations.
Sometimes trading 20 times the equity base of his peers.
And he single-handedly generated nearly 30% of the entire group's total profit.
So that sparked a fierce debate. Was this just a pure meritocracy rewarding Faith's aggressive application of the system?
Or did he have some kind of implicit guidance from Dennis? Was it a no-fail setup that gave him an unfair advantage?
And this unequal allocation led to direct challenges from the students themselves.
Sam DiNardo and Earl Kiefer both wrote letters to Dennis questioning the fairness and the efficiency of the allocation formula. Kiefer argued that if Dennis had just given equal allocations to all the turtles, he actually would have made more money overall.
Why is that?
Because he would have captured consistent returns across the entire risk spectrum, not just from the most aggressive traders.
That's a critical point, questioning the efficiency of the boss's own methods.
A very bold move. But DiNardo's letter, well, Dennis saw it as him just making excuses for his own poor performance, and DiNardo was eventually cut from the program.
So Dennis, despite his philosophical skepticism, seemed to have very little patience for self-justification when the numbers weren't there.
Not much at all. Meanwhile, during all this downtime and wrangling over money, a separate, monumental intellectual effort was happening.
4 of the second-class turtles, Tom Shanks, Jim Rabar, Earl Kiefer, and George Svoboda. They spent an entire year working together, secretly building a systems testing platform on original Apple computers to independently validate the rules.
And their efforts led to the memo that shipped the program. Their research uncovered a shocking critical flaw in the rules as they are being implemented.
What did they find?
They found that Dennis had the turtles taking far too much risk. Specifically, when the S1, the 20-day, and the S2, the 55-day signals happened at the same time, they were dangerously overexposed.
And their analysis showed that this blended risk could potentially lead to an 80% drawdown in a worst-case scenario.
Far, far exceeding the assumed 50% maximum loss Dennis had anticipated.
Wait, so the students, using the scientific method they were taught, proved that the teacher system was structurally flawed and could lead to ruin.
It is the ultimate vindication of the scientific approach. The rule set was brilliant, but it still needed refinement, and it was the students who found the mathematical vulnerability. It just highlights that trading success requires constant vigilance, even against your own systems.
But despite all the controversies and the technical flaws, the overall program proved Dennis's thesis.
It did. Trading could be taught. It satisfied the nurture hypothesis. And Jerry Parker's consistent excellence, even with a small account, proved the systematic approach worked even under constrained conditions.
But ultimate success demanded more than just following the rules. It required that persistent drive and courage, that walk-off home run mentality to stomach continuous losses while waiting for the big payoff.
In the end, the Turtles as a group grossed $150 million over their trading period. And Dennis, who had provided the capital, the system, and absorbed all the risk of ruin,
he took $110 million, 73% of the total profits. He maintained that it was fair. As he said, it was our money, we took all the risk.
And the legacy of the Turtles just confirms that pedigree, background, or your location, even a tiny country office in Mannequin-Sabot, they don't determine your success in the market. The power is entirely in the philosophy, the disciplined rules, and the mental toughness to apply them consistently.
Think about the second generation, someone like Salem Abraham, the famous trader from Canadian Texas. He never even met Dennis.
But just knowing that the turtle philosophy existed, learning the rules from someone like Jerry Parker, and having the courage to trust the math over his gut feeling, that was enough for him to achieve massive success.
The greatest lesson of the Turtles is that trading is not about being smart. It's about being disciplined. It's about having the conviction to trust the math over your emotions, especially when you are in a painful drawdown.
It's the mental toughness required to stick to your game and never give up.
That conviction is the ultimate takeaway. We've talked about the power of rules over judgment, the scientific method applied to the markets, the need for emotional detachment, treating money like score pebbles, and that critical difference between percentage accuracy and the expected value. The edge.
Now you know the fundamentals of what it truly takes to win the market game consistently.
Thank you for watching. Please like, share, subscribe, follow up in next topic.
Let's continue next topic. So we've spent, weeks now diving deep into the whole turtle experiment, the training, the philosophy, the math behind the risk.
And their ironclad discipline they drilled into.
Exactly. But all of that was just the classroom. Today, we're stepping out of that bubble. We're on to the post-experiment phase where, the rules meet the real world, where the students become the masters.
That's right. And this is the ultimate stress test of the whole hypothesis. Can you actually teach trading? And the Turtles proved, they absolutely proved the method worked. Nurture won.
They made fortunes.
They did. But our mission now is to figure out what else was needed. What did it take for long-term survival and, that massive, enduring success? Because it's one thing to make money with someone else's capital in a controlled environment.
Right.
It's a whole other ballgame to run a multi-million-dollar business, face these soul-crushing drawdowns, and handle the psychology of clients.
And our sources here give us this incredible, almost biographical look at what happened next. We're tracing the surprisingly, volatile journey of Richard Dennis himself.
The genius who invented the whole thing.
Right. And then the immediate kind of messy fragmentation of the turtle group and the quiet exponential rise of people like Jerry Parker and Salem Abraham.
And for you, the listener, this is really the final application phase. We're looking beyond just the technical rules. We're digging into the psychological barriers, the entrepreneurial hurdles.
It's the difference between knowing the rules
and having the sheer mental toughness and business sense to stick to them when the market is, actively trying to bankrupt you. It's the difference between being a student and being a survivor.
Okay, so let's start at the end of the beginning. The turtle program itself at C&D Commodities, it didn't just end with a nice ceremony. It just stopped around 1988.
Right. And the sources show this fascinating debate inside the group about why. Why did Richard Dennis shut down an operation that was just printing money for him? It was not a clear-cut victory lap at all.
Not by a long shot.
No. The end was really contentious. It left everyone wondering, was Dennis this principled guy retiring to focus on his ideals, or was he a trader in deep financial trouble trying to cover his tracks?
Let's take the first story, the noble exit.
Okay, so on one hand, he announces he's retiring. He says very explicitly he wants to focus full-time on politics, on his libertarian causes. And he was already a huge donor.
He was funding all sorts of things.
Everything from decriminalizing marijuana to battered women's shelters. He called himself a libertarian. So this political ambition, it was real. He was genuinely trying to affect change.
So that sounds like a plausible reason, retiring to pursue his philosophy. But the sources also point to a much more painful reality, a financial one.
And this is the narrative that really took hold among people close to the operation. The idea that his own trading performance was forcing his hand.
Outside of the turtle system.
Exactly. Despite the turtle's success, Dennis's personal financial situation was catastrophic. We have the numbers. His discretionary trading, highly leveraged, especially in funds managed by Drexel, it was just devastating.
How bad are we talking?
In a single month, April 1988, those funds lost 55%, an eye-watering 55%.
Yeah.
These drawdowns were so huge, his high-net-worth clients were panicking, just watching their money evaporate.
And crucially, his volatility was way, way higher than what the turtles were seeing at the exact same time.
Way higher. And his response to the client panic, he didn't apologize, he attacked them.
He condemned them.
Yeah, he turned the blame right back on his own clients, criticizing them for not having his steely resolve, for panicking when things got rough. He complained that no one had prepared them for the ride.
The irony there is just, it's incredible. The man who proved trading could be taught with rules was losing millions because he was relying on his own flawed judgment.
It's thick enough to cut with a knife. David Cheval, who was around the program, he estimated that Dennis's personal drawdowns might have been 100 times greater than what his systematic turtles were experiencing.
So he was breaking his own primary rule.
He was proving it. Discretion was the true enemy. The master proved his own rule by breaking it in the most spectacular way possible.
It's the perfect example of that psychological firewall the rules gave the turtles. A firewall Dennis himself just didn't have when he was trading on his own.
And even as his personal funds were just bleeding out, the turtle operation itself was this huge success. It was basically a financial hedge for his entire company, for C&D commodities.
So the students were keeping the teacher afloat.
Literally. Dennis estimated the turtles grossed, collectively, around $150 million over their 4 years of trading.
That's an incredible number, 150 million gross.
And that brought C&D a profit of $110 million. That cemented his win in the nurture versus nature bet with Eckhardt. The system was keeping him in the black, even as the inventor of the system couldn't stick to it himself. The machine worked better than the man who built it.
Okay, so moving from the financial side to the technical, there's this crucial detail that came out of research from 4 of the second-class turtles.
Right, Tom Shanks, Paul Rabar, Earl Kiefer, and Jerry Svoboda.
The original systems guys. And their work uncovered this massive hidden flaw in the rules Dennis gave them.
This is the risk revelation memo. And it's, I think, the ultimate testament to that scientific method Eckhardt always preached. While other turtles were probably, spending their money or networking, these 4 were on their early Apple computers building a testing platform.
And they were stress testing the combined System 1 and System 2 rules to find the worst-case scenario.
Let's just quickly clarify for everyone. S1 was the short-term system, a 20-day breakout rule. S2 was long-term, a 55-day breakout for catching those huge trends.
So what did they find when they put them together?
They found catastrophic risk. They figured out that the combination, as it was originally taught, exposed the traders to a potential 80% drawdown.
80%. That's not just a loss, that's ruin.
Total ruin. Far, far higher than the 50% they thought was the maximal.
How was that even possible?
Rabar and the team found it was a correlation risk. The problem happened when both S1 and S2 signaled a breakout at the same time in the same market. Let's say heating oil.
Okay.
Because the system just calculated unit size based on volatility, it didn't account for both systems firing at once. So a trader would put on the S1 position and the S2 position, essentially doubling their exposure to the same trend.
They were just piling on risk without realizing it.
Exactly. Overloading the same bet twice over, just because 2 different timeframes agreed. It completely broke the risk model.
So what was the fix?
To fix was basically a risk management overlay. They had to create filters or drastically reduce the unit size if both S1 and S2 fired at the same time. They had to make sure the risk per trade was never breached just because the systems agreed.
That is a stunning takeaway. It shows that even a system from a trading legend has to be tested, validated, refined. It proves Eckhardt's point about scientific rigor.
The students actually perfected the master system. They used the tools he gave them to find the flaw he'd missed.
So the program ends, the turtles are all wealthy, or at least on their way, and they scatter. But they had this huge wave of celebrity coming, right? Especially after Jack Schwager's Market Wizards book came out.
Oh, huge name recognition.
Yeah.
That book made them legends. And it gave them this incredible potential. But that potential was almost immediately compromised. They just couldn't stick together.
Why not?
Well, there was one big attempt to form a collective turtle fund. A broker named Michael O'Brien tried to get them all together. The idea was simple, pool your talent, pool your track records, manage money under one massive hedge fund.
Makes sense. But the meeting was a total failure. What happened?
Egos. Just pure, simple egos. Mike Shannon said that because they all believed they were probably the best traders on the planet, their pride was it was out of control.
So they couldn't agree on how to split the money.
Couldn't agree on the money, on who'd be in charge, on the fee structure. Every single one of them saw themselves as the star performer who deserved the biggest cut. The team concept was gone.
It's that classic human flaw, isn't it? The intellectual discipline just vanishes when pride and money get involved. The question changes from how to trade to how to run the business.
Precisely. They fragmented almost immediately. They all became these one-man roadshows.
Yeah.
And the challenge changed completely. They had to go from being a successful, rules-following trader for someone else
to being a CEO.
A CEO, a marketer, a compliance officer. They had to run a real business. And that's where that entrepreneurial skill became the thing that separated them.
And right as this is happening, the 5-year confidentiality agreement they all signed, it expires.
Right. And that immediately blows the whole secret system wide open.
This is where the Russell Sands controversy comes in.
Yes. Sands was kicked out of the program early, but he was the first one to go out and start selling the rules in public seminars. And this enraged the other turtles. They felt he was betraying this proprietary knowledge that made them all rich.
And they tried to discredit him, right, by saying he only got a truncated system because he left after a year.
They did, but it wasn't really true. I mean, he might have missed some of the later tweaks, but he knew the core rules. He knew the S1 and S2 systems, the risk management. He knew what mattered. The secret was out.
The system became a commodity.
It did. And that forced the successful turtles to defend their execution, not their knowledge, which led them to the biggest hurdle of all, the client.
They had just watched Dennis's fund blow up because clients pulled their money at the worst possible time. How did they deal with that, knowing their own system was just as volatile?
It sparked this huge internal debate. Fidelity versus practicality. You have someone like Liz Cheval, one of the most successful female turtles, arguing fiercely that clients who want high returns must accept high volatility.
You get what you pay for, essentially.
Her point was, you give them the exact high-risk program that made my track record, because if you water it down for client comfort, you kill the edge. She was a purist.
But most of them realized that regular investors, pension funds, endowments, wealthy individuals, they're not like the turtles. They can't handle it.
No. They focus obsessively on these meaningless monthly or quarterly returns, a strategy that loses money for 8 months, but then makes 100% in the 9th. That just looks like a disaster to an investment committee.
So the clients panic.
They panic and pull their money at the absolute bottom, right before the big trend reversal, just like Dennis's clients did. So the turtles had to figure out how to balance the system's power with a client's fragile psychology.
And Mark Goodman, who actually invested with a bunch of the turtles after the program, he pointed out another key reality.
A critical one.
Yeah.
He noted that all these trend-following systems are, by design, highly correlated. They're all watching the same signals.
So when the market trends, they all win together. When it's choppy,
they all lose together, which meant that the technical skill was basically uniform. Success in the real world, the competitive world, it hinged on other things entirely.
Like what?
Like entrepreneurial skill, like Paul Raybar, building trading systems for other people, or superior business management like Jerry Parker, or just pure marketing drive. That's what separated the temporary winners from the guys who built empires.
Okay, so let's fast forward a few years. It's 1994. Richard Dennis, after his political retirement, decides he's not done with the markets. He's coming back.
He launches the Dennis Trading Group. And the motivation wasn't some new intellectual breakthrough. It was, at least partly, because he was watching his old students just crushing it.
It was ego.
It was a fascinatingly honest admission of ego and competition. He said it himself. I kept picking up the trade journals and seeing how much money they were managing. I thought, I know I'm at least as good as some of these people. So I decided to give it another try.
The inventor couldn't stand seeing his pupils surpass him.
He needed to prove he still had it. But the way he did it this time was totally different from his discretionary trading in the late 80s. He completely swore off human judgment.
He went full computer.
100% systematic. He had learned his lesson the hard way. He said, I just can't see how any human could possibly compete with a well-designed computerized set of systems. He was finally religiously applying the discipline he taught his students.
He was admitting the machine was better than him.
Implicitly, yes, and it paid off big time, especially during that period of extreme chaos in August of 1998.
Right, the collapse of long-term capital management, LTCM.
The ultimate stress test. LTCM was the darling of Wall Street, filled with Nobel Prize winners using these complex mean reversion strategies.
The idea that prices always return to the average.
Exactly. But then Russia defaulted on its debt, the markets went wild, and all their models just shattered. LTCM collapsed and needed a massive bailout from the Fed.
And what was Dennis doing while all this was happening?
He was thriving, just like the other trend followers. While the mean reversion guys were getting wiped out by these huge sustained trends, Dennis's system had him on the right side of every trade.
Long the bonds that were soaring, short the currencies that were collapsing.
Precisely. He was up 13.5% in August alone. He was right back in the game, right there with his former students, just loving the chaos.
So he was vindicated, the system worked, he proved he could do it, but the story ends in failure again, doesn't it? 2 years later, in 2000.
It does. September 2000, the Dennis Trading Group liquidates. And once again, he was brought down by the very human nature he'd trained his turtles to overcome.
The clients again.
The clients again. His fund hit a staggering drawdown, minus 52%. Now for an aggressive trend-following fund, that's painful but not unheard of. But his clients, spooked by the Drexel blow-up years before, and with the dot-com bubble bursting, they just fled.
They pulled their funds right at the bottom.
At the absolute bottom of the cycle for trend following. The fall of 2000 was the low point for these strategies. And right after Dennis was forced to liquidate, the market reversed.
And his peers?
His peers, the turtles who held on, their returns shot up 100% or more over the next year. Dennis's clients panicked, yanked their money, and missed the entire rebound. So he was out of public money management. Again, an intellectual success, but a business failure.
So if Dennis's story is this tragedy of genius undone by discipline and client psychology, then Jerry Parker's story is the opposite. It's the textbook example of systematic entrepreneurial success.
And by far the most successful turtle. I mean, by any metric you want to use.
And the context of his success, where he built his company, Chesapeake Capital, is so important.
It is. The author describes this journey out to his headquarters in Mannequin-Sabot, Virginia. They're expecting, some gleaming Wall Street skyscraper.
Right.
And instead, they find this unassuming colonial-style brick building in a field. Now it's across from a strip mall and near a church preschool.
It just completely shatters that master of the universe image.
It's powerful, tangible proof that location is irrelevant. All that matters is the system and the execution. Parker's net worth, which was estimated at $770 million back in 2006, is proof of that. He built that fortune with mechanical discipline, not New York hustle.
And Parker always emphasized that it's not just about trading well, you have to run a business.
This is the key distinction. He said being a turtle was easy because Dennis's staff handled everything. When he went solo, he realized, oh wait, I have to raise money, hire people, do the accounting, manage compliance, all while trading perfectly.
And he applied that systematic philosophy to everything.
To all markets, globally.
Yeah.
Stocks, currencies, metals, energies. He even joked about trading Chinese porcelain if it started trending.
So he's not a market expert, he's a model expert.
Exactly. He insists their expertise is systematic trend following and model development, not commodity forecasting. He doesn't care what he trades, as long as it trends.
Which brings us to the irony of the trading room he donated to the University of Virginia.
Oh, it's a profound contradiction. He funds this state-of-the-art trading room at UVA, and it's explicitly designed for students to study fundamental analysis. Balance sheets, economic reports, news events.
Everything he thinks is useless.
Not just useless, but dangerous for a trader. His own company's required disclosure says that future prices are better predicted by historical price movements, technical analysis, than by fundamental analysis.
So he's funding the teaching of a philosophy he believes is fundamentally flawed.
He sees it as a distraction. He argues that trying to use fundamentals leads to this ridiculous focus on short-term monthly returns. It makes traders compromise their edge, trying to smooth out performance to look safe for clients, even if it means missing the huge trends.
He's also famously brutal about the single most fatal trading strategy out there.
Mean reversion.
The one that blew up LTCM. He says it's so seductive because it's emotionally gratifying. The traders get constant positive feedback. Hey, I have 55% winners. I'm always right.
Tidy little monthly returns. Tidy returns, emotional comfort. But the whole thing just loses catastrophically when the market fails to revert. That's the 100-year flood that seems to happen every few years. It wipes people out.
Whereas trend following is psychologically brutal.
Brutal. A low win rate, frequent small losses. But it's built for survival. It's built to capture those massive, unpredictable trends that make fortunes.
And Parker ultimately succeeded where others didn't because he seized the business opportunities.
This can't be overstated. Earl Kiefer said it perfectly. He said if Paul Rabar had partnered with the brokers from Kidder Peabody instead of Parker, Rabar might be the one running billions today.
Parker made the right partnerships.
He did. He executed fiercely. Kiefer's lesson is universal. Too many of us are presented with an opportunity in life and we hesitate. Parker didn't hesitate. That killer instinct to build a scalable business is what set him apart.
So let's bring it back to the inventor, Richard Dennis. His final conclusion on the whole experiment was that who they picked didn't make much difference.
That is the final sweeping confirmation of the nurture argument. Dennis said executing a good system doesn't require a genius intellect. In fact, he said great traders have to be dumbbells and following them.
Meaning you put all your creativity into building and testing the system.
But when it's time to trade, you turn your brain off and follow the rules like a machine. So success or failure, it came down to discipline.
So failure wasn't a flaw in the system, it was a flaw in the person.
Exactly. The ones who failed, Dennis said, they just gave up or they were just bad businessmen. Innate talent wasn't enough. It's like seeing a college superstar fail in the pros. They don't have the mentor toughness or the drive.
The cautionary tale that always comes up here is Curtis Faith. He was the youngest, made huge initial gains because Dennis gave him so much capital to manage.
Faith's story is just such a stark contrast to Parker's. He won big, but he couldn't manage it. He spent his millions on taxes, charity, and a string of failed businesses.
And later on, he came back and started selling the system himself.
The very thing he'd criticized Russell Sands for doing. It just reinforces the point. Winning big once means nothing if you can't manage the money in the business over decades. The discipline to trade is different from the discipline to be a money manager.
But the real proof of nurture, the ultimate proof that this can be taught, it lies with the second-generation turtles.
People who never met Dennis, but learned the method from the originals. And the best example we have is a guy named Salem Abraham.
Right. Abraham's story is just the most compelling evidence that this knowledge can work for anyone, anywhere.
He was a student at Notre Dame from this tiny remote town, Canadian Texas, and he decided he wanted to make his living right there, far from Chicago or New York.
And his path started at a wedding in 1987, where he met Jerry Parker.
By complete chance. And Parker's success trading out of suburban Richmond, it was the spark. It convinced Abraham that this disciplined, systematic approach could work perfectly well from a small town in Texas.
So he acted on it.
Decisively. He went to his skeptical grandfather, a successful Texas businessman, and convinced him to put up $30,000 as seed money.
And his grandfather was not optimistic.
Not at all. He basically said, you think you're smart, but those guys in Chicago are going to chew you up and spit you out. And they set a hard, non-negotiable stop. If the account dropped to $50,000, which meant a $10,000 loss, the experiment was over.
And Abraham got a baptism by fire almost immediately.
Oh, the first few months were brutal. His account dropped fast. He got down to $68,000, really close to that failure point right out of the gate. Most people would have panicked and quit.
But he stuck to the rules.
Rigorously.
Yeah.
And then came the payoff, the famous 1988 grain market drought. Because he was following the system which is designed to buy strength. He was long corn, wheat, and soybeans. And when the drought hit, those markets just exploded upwards. And he was, as he put it, very well positioned and rocked along to serious profit.
He made his first million by age 25.
He did. Proving the system works when you have the discipline to stick with it through the pain.
And his success comes from that core turtle mindset. Trust the statistics, not your intuition.
He uses this great analogy. He says, you can have a Harvard physicist who argues a coin must be 50-50, or you can have a statistician who's flipped it 1,000,000 times and found it comes up heads 65% of the time.
Abraham bets with the statistician.
Every time. He famously said, just because I don't understand it doesn't mean I'm not going to bet on it. That is the pure empirical mindset he got from Dennis and Eckhardt.
And that grit allowed him to build a huge firm from a small Texas town.
He is the complete lesson. The system works, but you have to find the opportunity, commit to it, and have that killer instinct to pull the trigger when everyone else is running scared.
So the ultimate takeaway from this whole deep dive into the turtle experiment, It's that knowledge can be transferred, it can be taught, but to actually succeed with it, you need this relentless, almost surgical practice. You need rigorous testing. And most of all, you need to be able to act decisively without hesitation, especially when everything feels like it's going against you.
Indeed. The market really is one of the last true meritocracies. The barriers to entry are low enough that anyone can win, regardless of their background. And, the fact that Richard Dennis himself is trading again, even if it's just his own money, it proves the fundamental appeal of the intellectual game.
A game that requires that constant commitment.
To testing, to iteration, and to flawless execution. And in the end, the student, Jerry Parker, he proved that consistency beats genius every single time.
Thank you for watching. Turdy, do not forget, like, share, subscribe, follow up in next video.